Hello, hello. I'd like to invite everyone into the auditorium. We're about to get started. If we can make our way to the auditorium, go ahead and get started. Hello, everybody. Welcome in. All right, we got some beer in us, some pizza, and now we're gonna learn about crypto. Can you picture a better night? I mean, I don't know. I don't know. This is pretty much it. Well, thank you all for being here. If this is your first time, this is Edge. This is our HQ. We are a self-custody multi-asset exchange platform. We allow users to buy, sell, and trade their crypto, just like we all love to do, all while holding your own keys. So we definitely think that self-custody is super important, and you should hold your own keys and nobody else. So that's what we do here. We are hiring. We have a couple positions open. We have 3 engineering positions, a financial analyst position, and then a couple internship opportunities as well. So if you are qualified and interested, come chat with me after the event. I do also want to tell you we have an in-person help desk downstairs every single Thursday. So we have someone down there who is just ready to talk crypto with you. Bring your questions, or if you just want to chat, we have our support team down there. And so we're really proud to be able to provide that to the San Diego area. Hopefully one day we can provide it to other cities as well. Let's see. Don't forget to enter the giveaway. I have some QR codes down here, $20 in Bitcoin, and then a swag pack from Edge as well. And then lastly, we do have our next meetup is next Wednesday, May the 4th. Of course, we're going to Star Wars theme it because why not? So I hope to see you guys all next week as well. I'm going to pass it over to June, and she will intro our sponsors and speakers.
Thank you, Madison, hostess with the mostess. Hello, crypto friends. Nice to see you all. Thanks for coming out. Thank you, Edge, for hosting us tonight. The pizza came courtesy of Parify. You'll hear from them in a second. And drinks courtesy of Crypto San Diego. Thank you, Matt and Jay and Brent. Because DeFi makes way more sense when you're a little toasted. And I just want to mention, so Bo is like, he's pretty much a savage when it comes to this stuff, and I learn from him all the time. He's been doing it for a while, so just want to make sure that if what he talks about tonight is confusing or hard, it is. But it's not if you have some time in DeFi. So what we have at Crypto San Diego are some more introductory talks coming up. If you want to check out all our meetings, you can go to cryptosandiego.org and you'll see a list of all the talks there. In 2 weeks, we're having a workshop on minting your own NFT. And then a couple of weeks after that, we're going to have a talk about Anchor Earn. Has anyone here using Anchor Earn to get a yield on UST? Put your hands up if you are. Okay, if you didn't put your hand up, then you need to come to Matt's talk, which is going to be, there's Matt over there. It's going to be on the 26th of May, and he's going to do a very slow, basic tutorial on putting your money there, and you can get 19.5% return on stablecoin. So you don't need to invest in any crypto, which can be volatile. It's just a return for it's kind of like a savings account. So if what you see tonight is a little confusing, then we have another meeting that will be more on your level. And if you're a DGen already, then you've come to the right place for Bo. But first, a little word from our pizza sponsor, the excellent Corlin from Parify. Will be up here in a second.
Thank you, June. Quick intro about Parify. We're a crypto native hedge fund. We have a token investing wing where we buy and go long on different tokens. We have a VC wing where we were the initial investors in a lot of early pioneering founders in DeFi, including Aave and Compound and Uniswap. And we also have a delta neutral credit fund. That's what I work on. So I do a lot of this delta neutral stuff full time. And we sponsored your pizza to be able to tell you if you're interested in this kind of stuff, please come talk to me. And we're hiring. So thank you. Off to you, Bo.
Hello. All right. Hello everyone. Thanks for coming out. So yeah, thanks June for the intro, and I'm Bo, and I will be kind of explaining to you guys some strategies around delta neutral investing that I kind of came up with over the course of the past year. So these slides are kind of adapted from a presentation I did at ETH Denver back in February. So if you've seen the YouTube video that I posted on the meetup link, it's going to be pretty much the same thing. So a lot of the information will be repetitive, but this is a nice chance to go a little bit slower, field any questions in between the slides. So if you have questions from the YouTube video, make sure you let me know and I will try to address them. So, all right, let's get started. Okay, so who am I? I am a graduate from Carnegie Mellon, majoring in comp sci and computational finance. And I spent my kind of early days as like a software engineer at two early stage database startups doing C++ development. And started in crypto, researching all this stuff back in March 2021. So actually not too long compared to some of the others out here. And I actually came in not really buying a Bitcoin or Ethereum or interested in tokens. I came in looking at the stablecoin yields. So if you're familiar with BlockFi, I think, it's Celsius, those kind of people, I was kind of interested in how they're getting their yields and how they were kind of beating the bank interest rates and even some of the kind of the crazy returns hedge funds might be getting. So with that, I'm focusing a lot on shorter term, low cost stablecoin strategies because I don't really want to be locking up my money for too long. There's a lot of other opportunities out there just in general for investments. So I want to kind of keep things liquid but still earning yield. All right, so what is a delta neutral strategy? Put simply, it's a way to take a long and short position in an asset simultaneously. So when something moves up or down, ideally you're not too affected. What you can do is, one way to take long and short positions, and to make it useful is that sometimes different protocols are offering different rates for being long or short, or there's all sorts of yield that you get from staking and mixing all these protocols together. You can take advantage of these differences in staking yields. So some examples, if you're familiar with perpetual trading, there's this concept called funding rates that you can kind of leverage and earn money on. And a simpler one is just lending across money markets. So if you heard of Aave, there's a lot of clones and forks of Aave that all have different rates. And if you can find arbitrage around them where you can borrow from one, deposit another, and earn yield, that's good. And the next one is a little bit more complicated. It involves covered calls. I won't get too deep into that. And so the focus of this talk is going to be on yield farming, and specifically, instead of just naively yield farming with 2 tokens that you buy, you want to borrow those tokens to kind of have the short position. All right, so here's kind of the steps for delta neutral leveraged yield farming. So first, you want to pick a pair with good farm rewards. Then you want to deposit stablecoin as collateral in order to kind of borrow these coins. And then once you have them, you find a platform that lets you leverage these tokens in the form of like a yield pair. And finally, as these token price fluctuates, you're going to hit something called impermanent loss. And in order to handle that, you're going to be wanting to adjust your position as you're getting more rewards. Okay, so how do where's the money to be made in this kind of strategy? So the first one is you're kind of you're depositing your stablecoin and just earning yield from people borrowing that. This is in the money market in the beginning. And then the next part is you're earning trading fees from the liquidity you're providing. And as for the negatives, you have the negative APR from borrowing these tokens that you're using to deposit in the liquidity pair. You have similar concept for the leverage yield farming platform, and finally impermanent loss, which is actually probably the biggest thing you want to be concerned with. So here's the formula if you want to kind of take a relatively safe 70% ratio. And we'll look at an example next. So here's where there's some deviation. So in the talk I gave back in February, I used Bitcoin and Avalanche, and I was using Trader Joe for getting some of the yields, but Trader Joe has since stopped emitting farming rewards for their lending platform, suddenly making those rates not worth it. I mean, it's still positive, but you can find something better. So here I was looking across chains, seeing what we can do, and on Phantom there's actually a nice, slightly more positive yield. So the first one is there's going to be this protocol called Iron Bank. It's a lot less famous than Trader Joe, I would say, but this is made by the teams that built Yearn, if you guys are familiar with Yearn. And so it's pretty legit, and they offer a pretty nice rate on USDC lending. And in this case, we're going to borrow some Bitcoin, and there's a lot of people that kind of want to earn yield on Bitcoin. So not too many people borrowing it, because a lot of times if you're in crypto in general, you kind of have like a good opinion on Bitcoin. So these borrowers, if you're borrowing it, you're kind of shorting it, and there's a lot of people, not many people want to short Bitcoin, I guess. So next part is, we're again using Alpha Homura. So Alpha Homura is probably the most popular leveraged yield farming platform out there, and they've expanded across chain to Phantom. There, you kind of execute the typical the leveraged yield farming play where you borrow additional Bitcoin and borrow additional Phantom to cover the 50-50 ratio. So if you think about it, you have $70 in Bitcoin at $35, $105, and then you want to borrow another $105 in Phantom to cover the other side. So now you have 50-50 tokens. You can form an LP pair and start earning the liquidity rewards. And the decentralized exchange that we're depositing this on is called Spooky Swap, and their token is called Boo, and you're getting a little bit of you're getting a decent amount of rewards there. So cool. So plugging all this into their formula that I showed in the other slide, you're kind of estimating around like 23% per year. Now this is you're very, very likely not going to get this because the price of Boo, Phantom, and Bitcoin, they all fluctuate. So you're going to want to do a little bit more thinking and also try to watch for adjustments that you need to make. Okay, so as you know, one way to help with doing all these calculations is to model what would happen in a programming language. So I use Python. It's pretty straightforward. I I didn't use exactly open source, but I think a lot of these formulas are open source. So and the main things you're looking for is how to calculate impermanent loss, which is actually this K field right here, or sorry. Impermanent loss is, I think I have, oh right, that's right. This is the formula for impermanent loss down here. And then if you get familiar with like manipulating code in Python, you'll be able to kind of factor in how impermanent loss affects your overall positions. Okay, so if you don't want to deal with coding, I can show you what it would look like to backtest the strategy. So if you had heard this talk last month and you wanted to kind of start then, what would have happened? So in total, you would have earned 2% on what you deposited, and so 2% in a month is pretty good. It actually translates to around 23%-ish annualized, which is actually surprisingly close to the number we estimated back then. So one of the things I want to call out is the difference between selling and auto compounding. So when you kind of deposit in Alpha Homura, they don't they don't sell the rewards for you. So they kind of like you're ending. Let me go. I'll just explain it. So you end up with a bunch of boo, because if you remember from previously, we're earning a lot of boo, and we most likely don't want that because that token might go down. So if you're kind of selling it as you receive it, you kind of capture the high end of the price, and you end up a little bit better. Okay, so here is an interesting look at the effect of impermanent loss. So one thing I would like to call out, I don't actually have the correlation graph between Bitcoin and Phantom, but you can kind of intuitively imagine over the course of last month, nothing has been really going crazy in crypto. A lot of things have been following Bitcoin, going down slightly, and yes, and you can tell from the data, because they're so correlated in the way they move, permanent loss is relatively low. And the orange line here is like assuming you sell rewards, and the blue line is assuming you kind of compound it, which means you let your boo sit. And by the end, you can see if you had sold it earlier, you would have been better off, and that's because the price of boo went down. If the price of boo went up, which like it did last year when Phantom was kind of getting a lot of hype, then you would have been better off just keeping your boo. So it's hard to tell what to do sometimes. Okay, so here is an example. Here is what would have happened if you had just held Bitcoin and Phantom. So this is where delta neutral becomes really important, because you want to understand what you're actually doing. What you're doing is you're foregoing a lot of the upside from being in crypto. And if you've been paying attention last year, the upside was actually amazing. I think Phantom went up by 2 or 3x, actually even more depending how early you looked at. And you would have kind of missed out on all those gains if had you been in this strategy. And that's, but as you can imagine, the inverse holds true. As the market is going down, you're typically pretty good, because you are, you don't have price exposure to Bitcoin and Phantom. And that's another thing where, so you might, if you are familiar with delta neutral strategies, you might kind of look and see some people want to pair like a stable coin with one of these tokens, like USDC Bitcoin or USDC Ethereum and so on. And although that's like another valid strategy, it is a little bit scary the way impermanent loss can happen when big swings in the crypto market occur. So anyway, so this is the 1 month chart, and okay, so now we're going to get a little bit more complex. But I guess before we do that, does anyone have any quick questions they want to ask? Yeah, go ahead.
basis
points do you think you would lose if you had impermanent loss insurance?
Okay. So the question was, how many basis points would you think you lose if you had impermanent loss insurance? Okay, so I actually don't know any impermanent loss insurance protocols. But let's see. So the basis points for impermanent loss. So this is, okay, this is, you don't have the exact numbers here, but you would have lost around, 0.5%-ish in a month. That's like 6% a year. So it's like 600 basis points of permanent loss if, if this kind of goes. If you, yeah, so I don't know, if someone wants to sell you insurance for that, maybe that's like a good idea for a new protocol. But yeah, not sure.
The Alpha Humana platform that you talked about that had the 3x leverage. What's the primary purpose of using that platform?
Alpha more. Okay, yeah. So yes, let me talk about why leveraged yield farming exists. So okay, so you have to be. I guess, all right, I'll just keep it on this slide. But actually, let me bring it back to this slide here. Okay, so when you are in a leveraged yield farm, so you can't see it here because surprisingly Bitcoin is lower interest rate on the leveraged yield farming platform. But typically because, so you have to think like who are the people borrowing these tokens, and if you're just kind of like something like Aave, right? People borrow the token and then they need to figure out what to do with it, right? Here, they know exactly what to do with it, and there's like a nice pretty screen that tells you, oh, if you click this button, we're gonna borrow this for you, deposit it here, give you this yield. So because of that, you get a lot of people who are just attracted by the yield, and they want to just go ahead and one click borrow. They don't think too hard about how all the APIs work, which means you end up with higher yields for just like lending and borrowing, higher borrow and lending rates on these leveraged yield farming platforms, at the cost of not being in full control over how if you borrow something, how you're going to use it. So yeah, so that's the kind of thing. It's just basically a different form of borrowing and lending platform.
So why are you using Alpha Homura versus say Terra or Impermax for your leverage?
Yeah, so I kind of just looked at the yields for them, and yeah, Alpha Homura was better. Impermax. So another thing is you want to be careful with liquidity on these platforms. So Terra has good liquidity, but I think Impermax doesn't, which means that the more you put in, the more your size of your position is going to affect the borrower rates, because the less there is to borrow, the higher these rates are going to go, and you're going to kind of quickly be paying rates that you don't really want to be paying.
Is Alpha Homura fixed?
No, pretty much everything you see in DeFi is variable. I know Aave and some other protocols offer fixed rates, but they're going to be like 12%, something insane. So, yeah.
Hey man, just a quick question. From like a tokenomics perspective, what do you look for before investing in one of these farms, as far as like the reward protocol goes?
Yeah. So yeah, if you look at what I'm doing, I actually don't really care what any of these tokens are. I just kind of the things I care about are the correlation between the two tokens, and the the borrow rates, the lending rates and liquidity and all that stuff. So yeah, I just kind of like plug it into this my equations here, and then whatever gives me the most money, I'll go in. Yeah. It's I think later on, so what you do want to avoid is like token volatility. So I guess that's probably the biggest thing. So the reason why I would pick something like Bitcoin and Phantom is because these are like pretty high market cap, low volatility. If you do go on some of these like yield farming platforms, you might find like way higher APYs, but those aren't. It's kind of like a bait because sometimes the tokens behind them, fluctuate wildly. And actually, that's a pretty good segue into my next section if there's no other questions.
I think there's one more
yeah,
here.
Go ahead, sorry.
What data sources do you use for your back testing?
I use CoinGecko API. Yeah. All right, so let me move on. Okay, so yes, so let's talk about what happens when you see these like more, I guess like farms that are a lot higher APRs. So what you can do is, okay, so you want to take part in this like this liquidity pool that's giving you higher APRs, but you're afraid one of these tokens might go down, or commonly one of the tokens that you're using in the farm is the same token you're getting as a reward. So you're kind of like your own sell pressure in that case, which is a little bit interesting to think about. But okay, so what you can do is borrow more of one token and swap to form the 50-50 ratio. So this is best used when you are like dealing with these like inflationary farm tokens, and where you're anticipating higher impermanent loss, which means higher deviation due to like all these like tokens being minted and sold constantly. And yeah, like I mentioned, you can kind of short it in anticipation of farming rewards. So you can kind of think like, okay, well, I'm going to sell it now, collect my money, and because I'm putting my capital into this pool, they're going to be giving me these tokens. So let's say I like sell 100 of these like arbitrary token. A month from now, a month later, I'm going to get it back. So I'm kind of collecting that yield up front, which is very nice to think about. And the problem with this is that it's going to be pretty hard to find these borrowing pools with these like farm tokens, because everyone's thinking the same thing. Like nobody really wants to buy these tokens and hold them. So yeah, who's willing to hold these tokens? Okay, so the example I'm going to be using is with Solana and Orca. So Orca is like a typical decentralized exchange. You can liken it to like the Spooky Swap Boo token that mentioned earlier, but you can see hundreds of these are out there. Okay, the starting point is a little bit different, but the borrow ratio and the rates are the same. So in this case, I'm going to be borrowing more Orca, and you can see that in order to borrow Orca, you have to pay 20% per year. So you have to be really careful that what you're doing is worth it. And I'll show you later, but if you mess up and let's say Orca actually goes up, you're even more screwed because in addition to you selling some of your Orca, you're incurring like a 20% borrow rate on an asset that's appreciating in value, which makes it even more bad for you. So be careful of this. Yeah. But anyway, as a result, you get a lot more farming rewards. So you're getting 20% Orca and a little bit in trading fees. But the main thing is these farming rewards. This is 20%. If you remember, Boo was around 8%. So there is some benefits here. Okay, so so with this, if you kind of backtest a month ago, you're actually going to be earning you earn 74% annualized. And the reason why is because, okay, so first here's the impermanent loss. And another nice thing is the reason I picked Solana and Orca is that, so Orca is the decentralized exchange built on top of Solana, where Solana is the underlying blockchain. And generally, if there's no at some crazy things happening in the market, at like the price of the underlying blockchain token and its main DEX are going to move together. you can see it's a lot less clean than Bitcoin and Phantom. You see a little bit more impermanent loss, but it's pretty good, pretty close. Okay, so here's the interesting chart. So you gotta remember what I did was I have a kind of 25% short position in Orca in this chart, which means, as you can imagine, I don't have the prices here, but you can imagine Orca actually went down compared to Solana. If you wanted to kind of take a look at the charts around like the end of March, you can see Orca was probably around like $3-ish, I want to say, and then now it's around $2. So so that movement actually you capture up here. But afterwards, the price of both of them went down. You can see this green line is what would have happened if you had held both Solana and Orca. And so you see the same thing, but you can kind of see that our line is a lot more volatile than the previous one, and this is because we don't have like a 50-50 position. We're actually not delta neutral exactly at this point. Okay. Oh, so here is the price ratio. It's not the exact price, but you can see at some point, just over the course of 2 days, two or 3 days, like Orca just dropped, and surprisingly, Orca has been, ever since the drop, it has been doing really well compared to Solana. So if you had started this position up here, you would have actually been in that worst case scenario that I talked about earlier, where Orca is increasing in price relative to Solana, but you are shorted, and it's just really messy. So this chart, I kind of show what would happen had you done different types of borrow ratios. So the left side is Solana and the right side is Orca. So if you had completely borrowed Orca, so no short position Solana at all, kind of take a bunch of Orca, borrow it, sell half for Solana, you would be this blue line up here. You can see massive gains, like 20% over the course of a week-ish. But since then, your yield has been gone down, and it's hard to kind of imagine. But imagine you got in at this top line right here. You would actually be down 10%-ish if you had done this strategy. So you have to be careful when you when you get in. So this green line, this is that 50-50, the really clean delta neutral. Like, you're not making anywhere near the kind of money you're making, but you're steady. And the thing is, like, despite the slow and steady growth, if you had done the Orca short, you would be way better off. But yeah, this is just at this point you're trading, and it's not really delta neutral. But okay, so here's some closing thoughts. Another big thing is as the price of these things move. If you remember, I had like around 70%-ish borrow ratio. That means if the maximum drawdown of your position, if it goes down by 30%, you're actually just going to get liquidated and lose, I think like 10% right off the bat. But different protocols have different ways of doing things. So make sure you are watching your limits if you are doing a more kind of sophisticated, having a short position in a particular asset. So yeah, token price pumps will liquidate your position, and the ratio fluctuations will liquidate your position. So, let me explain this a little bit more, because this is also important. So, okay, let's say that both Solana and Orca, their price ratio remains relatively the same. If both of them go up, if you remember, we were borrowing those tokens, back on Aave or some normal money market. So if that goes up, you're actually going to get liquidated there, versus your leverage yield farm. That's where the fluctuation really gets you. So 2 places to watch out for, 2 limits. Okay, another thing is the borrow rates and farming yield. So you can imagine, like, sometimes farms just stop emitting, and usually they'll publish when they're going to do it. So pay attention to the news, like don't get caught with like bad borrow rates when the farm yield dries up. And watch out for people, hopping in and like doing a lot of stuff. So I've been doing this for a couple months now. It's hard to predict exactly when borrow rates spike and decrease because it's hard to predict like demand for this kind of stuff. Like the thing that I just described, okay, yeah, this is straight up demand. Like you're gonna hurt me, hurt anybody else that does the same thing, which is probably why nobody really like broadcasts it. But some more users will kind of increase borrow yields and reduce your farming yields, diluting you on both ends. And yeah, so I think right now, the equation is positive. So, you should try to get in while it's still positive. I don't know. Who knows when it'll become when it'll dry up. So, all right. And another thing is, yeah, so what you can do is as people kind of come in, maybe a lot of people come into the safe Bitcoin Phantom yield farm. What you can do is you can rotate. Actually, exactly what I did before. So before I was on Bitcoin Avalanche, but the yields dried up, so I moved to Phantom. And maybe once Phantom dries up, there's a bunch of new chains popping up like Evmos. There's something called Aster. There's all these cool stuff coming up. So and Near's a big one. I think Near is this year's only real top performer, but we'll see what happens. Okay, so the low, yeah. Also, so pretty much every chain now is low cost besides Ethereum. So I guess maybe this can just be summarized as don't use Ethereum. So because you're going to be making a bunch of adjustments, you have to be careful. If suddenly some borrow rates increase, you don't want to be thinking about oh, should I pay gas to move it? So, and it's also interfering with a lot of Ethereum money is made on NFTs, and NFT gains are way bigger compared to what you're doing. So people aren't afraid to transact NFTs. You should be really careful when you transact when you're doing this. Okay, so yeah, in the end, not 100% passive, but maybe check once a day, follow the news, and you should be okay. Okay, so if you're interested in learning more, here's my Twitter, Discord, Telegram, and we can have more questions.
Hey, how are you? I have Phantom on Tomb Finance, earning Tomb shares, but I don't know about the lending. Why do you lend? Why do you lend instead of just staking Phantom by yourself?
Why do I lend instead of?
Why do you borrow? I mean, why do you borrow? Yeah.
Right, because I don't want to be exposed to the price of Phantom.
Just so your prices doesn't fluctuate. So you're just trying to get the interest off the borrow, pay off your interest from what you borrowed, and arbitrage the interest. That's what you're doing?
Exactly.
Okay. All right.
You do bring up something really cool, though. So I think, Tomb Phantom, maybe it's complicated for just the question, but yeah, there are pairs out there that are extremely tightly correlated, and Tomb Phantom is one of them. So if you want to do this strategy, if you find something that does Tomb Phantom pairs, actually there's something called Alpaca that does it. So yeah, you can try to get in if you believe in Tomb.
Yeah, I believe in Tomb and Phantom as well. And also Chronos. I'm on Chronos, BVS, LP, and Chronos.
Yep.
Atom LP.
Yes, so Chronos is actually interesting. I guess I would have been better off preparing some stuff some real world examples to show you guys, but maybe next time. But Chronos has this protocol called single.finance, and in Chronos the market is extremely efficient. So when you look at the borrowing on single finance, which is also a leverage yield farm, you'll notice that you can't borrow a single token, and this is because everybody on Chronos has already done this strategy. They've already borrowed the super profitable tokens so that there's nothing left for you. And the worst thing is that, let's say you are one of the people lending those tokens, right? because your tokens are being borrowed by someone else, you actually can't get out. So you won't be able to exit your lending position until that guy stops borrowing your tokens. And because the token keeps going down, he's not going to get liquidated. The token's still printing. He's not going to give up his position, so you're stuck. You're going to lose all your money pretty much. So.
Is that why your crow's locked up for 28 days on the DeFi?
No, that's different.
That's different?
That's
Okay.
different, yeah. But
Well, maybe on the Discord we could talk more about this or.
yeah. I think there's yes. If we there's a lot of like different like case studies we can do for different yield farms. But yeah, maybe we can like start a series of talks to go over those. But
So given how variable the APRs, borrow rates, and the incentives drying up, do you have a rule of thumb in terms of the time horizon for your positions, or it's more of a play-by-play kind of thing?
yeah, so I just kind of keep it until I need the money for something. So yeah, but thing is like, if I do need the money for something, I want to be able to like take it out. So that's why yeah, I try not to lock it up.
You had mentioned liquidity when you were examining the different protocols that you could do the yield farming on. And obviously with every investment strategy, there are minimums and maximums, just like, you can't buy a $100 NFT on the Ethereum network due to gas fees. It's like not. What is the most amount of Ether or Bitcoin or that you could facilitate in one of these transactions? Like, would it be advisable to put 100 Ether and, and on a pair, or would that be risky? Like, what is the size of this that would be realistic without putting yourself in like serious jeopardy for, the protocols that exist on the exchanges?
Right. So the Solana Orca thing can probably handle around $500,000 of liquidity. For Phantom Bitcoin, last time I checked, it's probably around 10 million before like the rate actually goes to zero. But so yeah.
So would you change, like if somebody put in like your example, like if I put the 500,000 on, or what are the 125 ETH or whatever that is on would that fluctuate the rates by you going into the position? Would that alternate the rates, or is this something more of like you put 10 ETH on it and cross your fingers?
No, it would alternate the rates. It would make it so that your borrow rate no longer outweighs the farming yield reward. So there's no point in doing it anymore.
So you would have to find a pair that could facilitate, like you said, like with Bitcoin, where it can handle millions and millions of dollars, and it's not going to blink an eye.
Bitcoins are nice, and if you're really, you can be clever about these things by like. So this is kind of not exactly. It's like delta neutral hedging is a concept where you kind of like. You can borrow Bitcoin and sell it for maybe Phantom or something. So like maybe Phantom doesn't have amount of liquidity to handle that, but Bitcoin sure does. And you have a lot more people who are like, I don't want to say irrationally holding Bitcoin, but like they're like super into Bitcoin. They'll never let it go. So it's a lot easier to like, buy Bitcoin and like borrow Bitcoin and like sell it for other stuff. So if you're trying to like farm, and oftentimes like Bitcoin doesn't like outperform enough to make that worse.
Yeah, so I guess.
Oh, yeah, sorry. The question that I had was around, do you have any open source tooling for this? And how do the APIs look with these DeFi farms?
Yeah, so I don't know, I just, none of the things I'm doing are very compute intensive. So you can just like, pull it from CoinGecko. It's a free API. And in terms of open source, like the CoinGecko API is open source. You can kind of like look at how everything works.
Sorry, the question is more about like the tooling for the actual strategy, not the API tooling to query the data.
Yes, so that is an interesting piece. And I have thought about kind of making this more automated. But the thing is, if you make it more automated, you're going to get more people on it, which actually hurts your position. So it's interesting. It's like probably a lot of the reasons Now, the alternative is you kind of capture that, but it gets a lot more complicated and so on. So I haven't found the need to build tooling for myself just because I don't change, I don't like kind of move my positions so often. But it would help. Like if I had something more automated, then it would be like 100% passive. And there are protocols out there that do it. So Single Finance, that's one of the people. That actually might be why it's completely saturated, because they made it so easy to do this that everyone dived in and started using it. So I think Delta One on Solana is another one, and what else? Yeah, I'm not sure, but there are protocols coming out that kind of automate this like adjustment. So,
Yeah, I mean, I think it kind of goes along to what he said, because was real kind of interested on what Verify Capital actually does, because there was this one company I talked to at Bitcoin Miami recently, and I feel they kind of are working towards automating it on the front end for the user, even though they may themselves on the back end be executing these different strategies and rotating the crops basically.
Right.
So yeah, I mean, I was kind of interested if kind of like that's what you guys over at Verify Capital are doing, anything like that, because when I talked to this guy about it, I'm a CPA, not a lawyer, but my immediate concerns was like, I don't care if you're doing this through Circle's API and it's actually Circle that has custody of the assets. If you're having other people, if you're taking other people's money and guaranteeing this yield, that sounds like a security to me. But then he kind of gave the example of, kind of this intermediary that's using existing bank products that provide a specific yield. So that sounded more like it would only require a money transmitter license. So I do feel that, like I said, that kind of does carry on to like what is being done to automate these strategies, like what he had asked. But like I said, I'm really more curious as to kind of what your company, Verify Capital, is doing kind of in that space.
Okay, so I'm actually not part of Verify, so I don't know what they're doing. But I will say that this like automated strategy, I mean, you already see people doing it. So, and it's not like everything is none of this has any sort of custody. Like it's all like you go in, you click the button, and you do it. And
that's the main thing I was asking.
Yeah, and it's all like, and it's not using APIs. It's like smart contracts on the blockchain. So like you can look at what it's doing.
Yeah. I do work for Verify Capital. I'm happy to talk to you about that.
Yes.
The custody and regulations are something that are always giving us nightmares. So that's fun. But I was going to ask you a question, Bo.
Yeah.
Where do you typically source your alpha? Like, where do you learn about new protocols and things like that?
Yes. So let's see. So there's a few YouTube channels. There's one called like Caesar's Snack Sandwich. I like that guy. Yeah, he's very small. He gets like less than 1,000 views, which is probably why it's still called alpha. But and then another one is Taiki Maeda. He has like a paid Discord that I'm part of. So sometimes people talk about strategies there. Other than that, yeah, some of the people I follow on Twitter just like sometimes people will post about it. Looking on for the rates like the weird thing about these rates, like they're just out there, and I guess people aren't like super serious about. So I guess one thing is that like you have to compare this to actual real trading, and I think that a lot of people that are like more sophisticated probably have are more comfortable just like trading during profits. So that's why I sometimes just like look at protocols, like for example, for this like Phantom Bitcoin thing, I knew that's right. You can go on DeFi Llama to like look at a list of all the protocols on a particular blockchain, and one by one you go through them, visit their website, look at their rates, see if it's possible.
That's pretty much it. one thing I want to bring up is since these guys asked, is there any open source tool to check the APYs on different LP pool fees or APYs? There is a website called apy.com. I believe a lot of people already do know. You can check on a specific pair of tokens and see how is the pool APYs is like.
Right. So no, I don't know of any. I think, yeah, I don't know of any. It would be, the hardish part of building that is just there is some, so in addition to, so what I did was I just built the back end for it. And when I plug in the numbers, like plug in the APYs, I manually go and check it out. So it's a little bit inefficient, but I'm not, super dedicated to making the most amount of money possible. But yeah, so if you were to kind of scrape websites for all these APYs, I think you could do it. You would need to find someone who's motivated enough to work on something like that, because
Yeah, what I just said is there is a website already built which is called apy.top.
Okay.
It had a lot of single staking or LP APYs already there. It's not the most accurate one. You want to double check with yourself.
Yeah. So yeah, that would be like that'd be like a cool extension of that website. Like if you could, in addition to having just the straight up farming APYs, you can have the borrowing rate APYs, and then start running this back end on their website. That would be nice.
I had a small and simple question. Just curious, how much of your bandwidth or time on a daily basis would you say this consumes you in terms of adjusting or coming up with new strategies? How much do you have to keep up with it? You said maybe check it once a day.
Right. Okay. So the only reason I check it once a day is because I'm super scared that I'm gonna lose all my money.
Understandable.
But yeah, you you can imagine, based on the simulations, right? You can see that having that 70% borrow ratio, it's unlikely you're going to be liquidated. So, especially if you're doing something like Phantom Bitcoin, you really don't need to do anything. The one problem is that, so some protocols, they don't sell the farm token for you. So if you wanted to do that, you would have to do that daily. But yeah, that's pretty much it. So
When you sell the farm token, you sell it and re-auto-compound it? Like sell it and get back the native one that you staked for the farm token?
okay, so when you sell it, you oh, sorry. So yeah, so how do you kind of sell the reward, right? So there are some people that will auto compound for you into the, okay, so this is where all the different yield farmings have their flares. Okay, so there's one that will just give you the token, do nothing to it. For that one, it's pretty easy. You sell it to cash, and then you put the cash back into the very, very beginning, and you borrow more, and then you deposit more. Yeah. And then some of the other ones where they kind of automatically sell the token and put it back into your liquidity pair. It's kind of nice because you don't actually have the farm token anymore. So, and I'm okay with having a little bit of Bitcoin Phantom. That's fine. Especially because what I can do is I can, in anticipation of receiving more Bitcoin and Phantom, I can sell it, a week before, sell a little bit of it, put it in cash, and then I can kind of balance it like that every week without incurring too much transactions or complexity.
Yeah, and on this strategy, are you manually inputting the impermanent losses? Are you adjusting those data?
Yeah, in the formula, or sorry.
Let's say one of the coins goes down, the impermanent loss. Do you manually go in and add more tokens of the?
Oh, I see. Yes, adjusting your. Yes, I do. That's a good point.
Okay.
The reason. Okay, so. Yes, the reason why you would do, so the first reason is pretty obvious. You don't want to get liquidated because the more impermanent loss, the more your position is going to go down, and you have to rebalance it to get it back up. The second reason is that this is where it gets a little bit in trading. Is if you want to like you want to decide what you do with momentum, because a lot of times, like as you're seeing token go up and down, so Bitcoin Phantom, as Phantom is going up, if you believe in momentum, there's a good chance it's going to keep on going up. So what you should do is, like, you know, on a day that you see Phantom go up, you see your impermanent loss, your position's unbalanced. You can either like wait for it to, you know, be rebalanced, or you can, you know, sell Bitcoin by Phantom to rebalance it. And it's hard to know exactly what to do, because it's all depends on what you believe about momentum. And that's it.
We just had one of the worst days of the year, tax day, and I'm wondering if tax loss harvesting is imperative to the strategy, or not looking necessarily for tax advice. But
Yes, no, I'm glad you brought it up, because that's. Yes. Okay. Yeah. Because yes, because what you're doing here is you are incurring income, because yield is income. So I think you know, I just do the safest thing. Everything here is counted as like straight up income tax, and then don't worry about like capital gains, trying to get the most. So.
Buy an NFT with your profit and then sell it for a loss.
Yeah, it depends on how deep they look at it, because if you bought an NFT, you realize those profits, and you theoretically should get taxed on them. So it's
And the thing is, like, you're talking about getting regular income from interest or your rewards or whatever. You're only gonna be able to offset that up to $3,000 on a capital loss if you do like buy an NFT and sell it for a loss. I mean, yeah, that's the thing on these where you're getting some type of yield for staking or farming. Eventually, it is considered regular income. You know, at best, it's regular income when you sell it for fiat, but under the strictest of guidelines, it's income as soon as it hits your wallet, your possession. So. Yeah, but like I'm saying, it's different than the capital gain income, so you can't offset it dollar for dollar, only up to $3,000. And then it could carry over to the next year, though. So.
All right, any other questions? All right, well, let's thank our speaker for all this awesome information.
I just have one thing to mention. Thank you, Bo. You're amazing. Are there any POAP addicts in the room? All right, a couple. All right, we have a POAP for tonight. It might be a little bit amazing. A POAP, if you don't know, it's an NFT for attending. It's it stands for Proof of Attendance Protocol. So if you don't know what that is, if you're interested in learning, come talk to us. Jason with the Chainlink hat over there is the POAP master, and he has he has the POAP codes. So you can get a free NFT for showing up and staying to the very end. Congratulations. Collect your POAP. And just to close, Paul is going to say good night, maybe, but he's probably going to work all night.
Thanks so much, June, for bringing everyone out here. Thanks, Bo, for the presentation. For those, as June had mentioned, who had some of that go over their heads, you're not alone. But you got to start somewhere. And I guess June's going to put together a bunch of different meetups that help people from the ground up. And the up, there's no sky's the limit here in crypto. So I want to thank everyone for coming out. And just to reiterate, once again, this is the home of Edge. We do host quite a few different events for various different cryptocurrency meetups. If you do host events and are looking for a space, contact Madison. As well, on the track of where we're going, we are hiring. So we are looking for both developers, marketing interns, other internships, as well a financial modeler. We are very, very passionate about DeFi and looking to really simplify DeFi the way we did for just owning, transacting, buying, and selling cryptocurrency. That's one of our focuses. Definitely give the app a try. If you install it today, we'll just look for someone in an Edge shirt. We'll toss you $5 of Bitcoin just to give the application a try, create an account. Ways that we're simplifying DeFi that we're really excited about. Ironically, this presentation was very relevant. One of the things that we just launched today, actually the timing was impeccable for this meetup, was really taking staking, and many of the transactions required to stake on a lot of different dexes. We focused actually with our launch today on, ironically, Tomb and Phantom. So today we launched support for Tomb and Phantom, not just Tomb Swap to be able to swap between assets, but in a single operation. Normally it takes about 5 or 6 different steps if you use MetaMask. You can now stake 2 assets on Tomb and Spooky Swap, take the LP token, and automatically stake that on Tomb for additional rewards in one operation. So really taking a lot of the complex processes that you have to go through to use DeFi and simplifying it as much as possible. And we intend to take that and bring it to other different dexes and LP pairs, I think Uniswap and other swap providers, things on like not just Spooky Swap, but what's the one on Binance? Sushi Swap and whatnot, as well incorporating other aspects of DeFi protocols. So if you happen to be a fan of Phantom and Tomb, give it a try. Feel free to pull aside one of the Edge staff. We can give you a little bit of a demo. And then definitely subscribe to our newsletter because there's many more DeFi integrations coming down the pipe over the course of the next year. So thanks again for coming, and definitely see you hopefully next week. That's the Bitcoin Open Blockchain Meetup on Wednesday night. And we have a couple different presenters right behind us. So it's going to be Ember Fund and CrayPay. Ember Fund, an amazing application, allows you to deposit into the equivalent of a self-custody hedge fund. A lot of people don't have the ability to go into a traditional hedge fund because they don't have enough capital or it's not in the right region. Well, crypto is all about self-custody. So learn how they're enabling the equivalent of a hedge fund where someone helps make the decisions of how your funds are allocated, but in a self-custody manner in an app. And they happen to be a partner of ours using the Edge SDK to secure your funds. And as well, CrayPay, you'll get to learn about what they're doing in a very fascinating way to achieve a high level of privacy in traditional finance incorporated with crypto. Really exciting stuff that they're doing, and they're also another partner of Edge. So I'm very excited about those 2 presentations. Hope you guys can come out. May the 4th be with you. Take care, everyone.
I do have our giveaway if you want to stay in your seats for a couple more seconds.
On your butt if you want money.
Yes. Let's see. Yeah, it is too late. Sorry about that. All right. We're going to go ahead and do the raffle. It's just a few of you, so your odds are in your favor tonight. Let's go ahead and give a quick drum roll for our winner, $20 in Bitcoin and an Edge swag bag. All right, there we go. We got our winner. $20 in Bitcoin and an Edge swag bag. Find me at the end of the night, and then just so you all know, like Paul said, if you download Edge tonight, you get $5 in Bitcoin. So, I mean, we can tack it on to the 20 if this is your first Bitcoin wallet. And are we taking the party to Princess Pub after June? Okay, awesome. Well, after the event, you'll know when it's time to go because I'll start flickering the lights and kicking you all out. We'll take the party over to Princess Pub. So this is your journey. Awesome. Thank you guys so much. Enjoy the rest of the night.